Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me David Jensen. We're sitting here in Vancouver, British Columbia today. Just finished attending a mining show, a gold mining show. And so really pleased to have David with me again. Thanks for joining me, David.
My pleasure, Jay. Good morning.
It's really good to talk to you. I wanted to get some of your ideas on what Dr. McHugh just talked about.
Sure.
You know, he's very concerned based on he's a technical analyst. He looks at fundamentals, but first and foremost technicals, and his jaws of death and also something he calls the Hindenburg Omen convinces him that there's a very high probability, perhaps soon, but by the end of this year, of a stock market crash. And by that he means a 15% decrease in the equity market prices, which I think is not that outstanding, but at least a 15% decrease. What do you think? As a fundamental analyst, David, how do you view the markets? And do you think that McHugh is crazy?
No, I think we are set up for a very strong stock market decline because the stock market rise over the last several years of QE, of quantitative easing from the Fed, was really driven not by economic fundamentals, but by the banks who were taking the QE which they received, the quantitative easing, more than $2.5 trillion on the Fed's balance sheet as excess reserves as a consequence of that. And they were using this capital, which was being held as excess reserves, as margin collateral for margin debt with which they were using, with which they were juicing the markets. So the markets were rising not based on economic recovery, but based on stimulus to the stock market through the use of margin accounts by the major banks that were playing in the market.
Yeah. Also, one of the big takeaways from Dr. McHugh that we just heard, he also is, if he's bearish on the equity markets, he's almost just as bullish on gold and silver. But he sort of thinks that maybe it's going to take a little while because, he sees all this psychological damage on the way down. It's been a very tough 3-4 years for gold bulls, that's for sure.
Yeah.
I can attest to that. So his idea is he's quite sure that that we bottomed out, probably almost certainly have bottomed out, and that we're heading into a new leg up in the bull market. But he thinks we're going to get off to a slow start. What are your thoughts, David?
Well, looking at the chart, if you look strictly at the chart, I would agree with him that these things take a long time to recover from. But when we look at the fundamentals of the gold and silver market, the analysis that we've done the last couple of weeks, looking at the LBMA, I don't believe the gold or the silver is there to back those positions, and I believe that there's a global movement afoot by central banks and investors to withdraw gold from the system because they can see the problems with these markets. So London is illiquid, and I believe that we're at some point going to see a default event by one or more major players in the LBMA, and I think that's going to set off a enormously rapid move in the price of gold and silver, akin perhaps to the movement in the Swiss franc, which we saw go very, very quickly to a much stronger level once the SNB made its announcement last week.
Yeah, because when things are based on, when they're not based on fundamentals, but they're based on some political maneuvering or some laws that were passed and not based on economic fundamentals, then things can change very rapidly. I think it's a psychological change that certainly could propel things very, very rapidly, and nobody knows for sure how that's going to work out. David Jensen is with me. We do a podcast every Wednesday. It's usually posted on J. Taylor Media by Thursday, if not earlier than that. And David comes in with some very, very astute observations of the markets. And David, you just come up with some things again today that you would like to share with our listeners. Would you pass those along?
Sure, Jay. Just 4 quick points here is noting that gold and silver continue to run strongly with the U.S. dollar index running strongly itself, indicating that gold and silver are outperforming all other major currencies. Noting today that the second point is that Mervyn King, the former governor of the Bank of England, said that QE doesn't work, and the comment in the article was, it's funny how these Fed chiefs get honest after they're out of the central banks, out of the stewardship positions, and when they're in there, they're just doing the same thing, just juice. A third point, which was curious, is that the Fed's bullard who said that they would extend, he thought they should extend QE in October and turn the markets around from a strong decline, now says he wants to get going with a rate hike. And they need to raise rates 4%. And I really see that as a move to battle the gold price rising because of the negative real rate of interest. I think it's probably north of 5%, but by the Fed's numbers, it's probably the order of a couple of percent. And I think he's trying to signal that they're going to move to positive interest rates to try to support the dollar and the bond market. So it's really, talking down gold and talking down silver. That's what these, there's a lot of talk. I've seen people call the FOMC the Federal Open Mouth Committee. And so we see Bullard back at it again, using that tool. And then the fourth note here is Jim Rickards has come out and said that gold price suppression is for China, to allow China to take a position in the world gold market before we go to a new gold currency. So it's really for China that we're doing this. It's China's fault. And, I don't buy that. It's been more than a couple of decades of gold suppression and interest rate suppression. And we've had colossal global bubbles that have been blown in the last 20 plus years. And that certainly wasn't for China. I just don't get this talk, and really it looks like there's finger pointing, blaming the Chinese now for this gold price suppression scheme, which I think is not a fact at all.
So he's suggesting that we are suppressing the price of gold so China can get their gold before we realign the monetary system, the global monetary system. Essentially
to drive interest out of the market to make the bullion available at a decent, fair price, and that there's bullion available for China. So,
well, I'm wondering how much gold China has. Of course, nobody knows for sure. But, there are certainly some reports that we've heard, and you've talked about, David, on our podcast and on this show from time to time from David Jensen and others, that China has been pulling in a huge amount of gold.
Yeah.
And we wonder where it's all coming from, if it's true.
Yeah.
Because there just doesn't seem to be that much gold around the world to accommodate that sort of, those numbers that we're seeing. And, there is some good reason, David, we've got a couple of more minutes left. Perhaps you can talk about this, but there is some good reason to believe through the Shanghai Exchange that there's actually physical metal that is entering China, right?
Yeah, Kuz's work shows the last couple of years more than 1,500 tons of visible flows into China, and the estimate is more than 15,000 tons to date has gone into China, but that excludes the Chinese federal government purchases, which haven't been released, I think, for 4 or 5 years. So the chances are that China has an enormous gold position. This is why we have to let the price rise before we deplete the coffers of the West and prevent ourselves from functioning in a going forward a global gold currency or a gold monetary system, which is a sound money system as opposed to the current digital virtual money system that we use.
Yeah, and as we were saying earlier, in terms of the markets can move very, very rapidly when they're not based on fundamentals and when psychology takes over. And that's why I would just like to suggest to our listeners that it's important that you secure some gold and silver in your own possession. Don't buy the ETFs. Buy the gold and silver, the physical. Put it away in some safe place. Because, as one person said, when the masses decide that when they give up on paper and they want to own gold, it will be like Niagara Falls going through a garden hose. There just will not be the capability of accommodating all the demand, and the price of gold and silver could rise very, very rapidly, unlike Dr. McHugh is suggesting a nice orderly rise, which I would much rather see, honestly. But, these are markets that are unstable because the politicians have stepped in and have not allowed the markets to adjust on a regular basis. David, we might have another minute or so. Any other ideas that you'd like to pass along? I should tell our listeners that David and I, again, we have a podcast weekly. We call it a weekly look at the gold fundamentals with David Jensen. And next week we'll be doing this again. So I hope all of you will tune in to hear what David has to say, because he has a lot of great insights into what is really taking place in the physical markets as opposed to the paper markets. Very important to understand this stuff, but is there anything else you'd like to add, David?
Well, I guess in recapping everything is that the markets are natural systems, and when you manipulate natural systems, these manipulations tend to fail according to what's called criticality theory. And you could sum it up by just saying that they fail in a binary fashion. They go from a 1 to a 0 or a 0 to a 1. And so that's why I think there's this potential here for a repricing move as the manipulation comes undone by the illiquidity of the physical London bullion market, which I believe is a real artifact, and we will know more with time as we observe the market going forward.
Yeah, and I would just like to close off by saying that having been up here in Vancouver and visiting a number of gold and silver mining companies, I think that I have never been more excited about the prospects of making a lot of money in the mining industry. I would like to also, though, suggest that you first buy gold and silver before you put the next money into the mining shares. But if your portfolio allows you to, I think there could be some substantial rises in the gold and silver markets. And David and I were just looking at the charts of a few of these companies, and they seem to be breaking through some of their critical long-term moving averages. So I think we're at the cusp potentially of something fairly major and some really great opportunities on the upside. And I think you agree with that, David.
Yeah, I would agree with that. The essential to hold the metal first is your core position, and then you can leverage up with equities as you wish.